Welcome to the Stock Market Palantir. Today, we're going to talk about IRBT, iRobot Corporation. This one represents one of the most compelling, if pretty depressing, case studies of rapid corporate deterioration we've seen in a long time, especially following the collapse of that Amazon acquisition. That deal was basically the foundation the company's stability was resting on. And now, well, that foundation has completely crumbled.
It is a profound corporate tragedy. I mean, when a strategic merger of that size collapses, the fallout is rarely gentle, but the pace and the depth of IRBT's decline are truly alarming.
Alarming is an understatement. This failure has left the company structurally insolvent. It's facing a severe liquidity runoff, and now it's been strategically checkmated by its own primary manufacturing partner, Pikaija Robotics. This isn't just a distressed situation anymore. This is a corporate endgame.
Right. And that endgame is what we need to focus on.
Exactly. So the core question we need to address for our listeners, for anyone looking at this ticker that's still, trading in the low single digits, is this. Given the confirmed insolvency and Patia's aggressive loan-to-own strategy, is the equity fundamentally worthless? Or do these extreme market microstructure factors, I'm talking about the massive crowded short interest, create some kind of legitimate, final, high-risk speculative opportunity? I'm going to argue that the financial fundamentals, combined with that strategic checkmate by Patia, they dictate zero recovery for common shareholders. There's no path to recovery here.
Okay, I see why you think that. And I certainly agree that the fundamental reality of the balance sheet points squarely toward eventual liquidation. But I come at it from a different angle. While the financial death sentence seems sealed, I believe the technical setup has become so volatile, so extreme, that it's sort of decoupled the immediate trading dynamics from the underlying value. The highly concentrated bearish positioning, and we'll get into the data, it creates this technical anomaly. It introduces the very real possibility of a bankruptcy squeeze that, frankly, sophisticated volatility traders cannot and should not ignore.
All right, well, let's ground this in the unassailable facts of the balance sheet, because that shows the true gravity of the situation. The company is technically insolvent. The Q3 2025 financial results confirmed this collapse, across the board. Revenue imploded to $145.8 million, which is a massive 24.6% year-over-year contraction. For a fixed-cost heavy hardware business like iRobot, that level of revenue decline is just disastrous.
The revenue contraction is significant, yeah, but I would argue the margin compression is even more telling of the structural decay.
You're absolutely correct. Even worse than the top-line decline was the gross margin contraction to 31%. This indicates not just lower sales volume, but a deep competitive failure, heavy discounting just to move inventory. But the real disaster, the immediate, unavoidable crisis, is liquidity.
And liquidity is the key to corporate survival. And IRBT, it has none left.
Correct. Cash and equivalents plummeted to a mere $24.8 million in Q3 2025. And what's even more alarming is that they've fully drawn down every remaining source of capital, including the $5 million in restricted cash. Management was forced to explicitly disclose that they have, and I'm quoting here, no sources upon which it can draw for additional capital. This isn't a rough patch. This is a company that cannot meet operational demands and service its debt.
That disclosure is critical. It really moves the discussion past any kind of turnaround strategy and firmly into emergency procedures.
And the emergency procedure was dictated by that strategic debt transfer on November 24, 2025. Pisia Robotics, which, many know as the former 3 Robotics, their key supplier and now competitor, they acquired the Carlyle Group's $190.7 million term loan. This acquisition is the strategic checkmate. PCET now controls the secured debt, which sits at the very top of the capital stack. And when you factor in the $161.5 million in trade payables PCET is already owed, $90.9 million of which is past due, PCET controls over $352.2 million in leverage. They are now incentivized to foreclose via a credit bid.
A credit bid. Yeah, maybe for listeners who might not deal with distressed debt daily, it's essentially where the debt holder, so PCA in this case, uses the debt itself as currency to acquire the assets of the company in bankruptcy, bypassing any cash buyers.
Cured. It stands ahead of all other claims, including common equity. That wipes out shareholders, full stop. Paitea, as the senior secured creditor, determines the outcome.
Okay, that is a compelling argument, and I cannot dispute the fundamental prognosis. Paitea is in the driver's seat for liquidation. However, I come at it from a different way, focusing purely on tactical risk arbitrage. While the market is pricing an insolvency, it's the aggression of the bearish positioning that creates this unique tactical opportunity for volatility, which is, totally distinct from an opportunity for fundamental recovery.
So you're focusing entirely on the short interest numbers then?
Precisely. And the members are staggering. Market microstructure data confirms this aggressive, maybe even reckless bearish positioning. Total short interest is at approximately 12.45 million shares. When you compare that to the tradable float, we're looking at 39.64% saturation. This is a highly crowded, highly levered trade, regardless of the merit of the underlying short thesis.
But the short thesis is supported by reality, unlike in some other speculative bubbles we've seen.
Agreed. But this extreme concentration introduces an asymmetric volatility risk. Imagine a crowded theater where everyone is trying to exit through the same door at the same time. That's what 12 million shares of short interest represents. If Paitea announces a strategic takeover or structured bankruptcy that includes even a nominal premium, even if that premium is just a few cents above the current market price, the resulting scramble to cover those 12 million shares could trigger a momentary, violent price explosion.
The dead cat bounce, or the bankruptcy squeeze, as the retail traders have coined it?
Exactly. And we've seen this play out with the Hertz and Revlon precedents. Traders are explicitly gambling on this technical failure of the short position. And what's more, the dark pool data confirms the institutional short conviction, which paradoxically just amplifies the risk. Off-exchange short volume ratios consistently topped 50%, peaking at an astonishing 69.68% on November 25th, right after the PAA news broke.
Okay, for clarity, dark pool short volume indicates that institutional distribution, so the selling and borrowing of shares, is heavily concentrated away from the lit exchanges. It's often used by bigger players to minimize price impact during massive sell-offs.
Correct. And this heavy short concentration means institutional shorts are vulnerable to a sudden liquidity event. They may have thought they were executing a slow, controlled distribution, but if a trigger event forces massive covering, they are vulnerable to rapid, uncontrolled volatility.
But let's address the finality of Paitea's position, because I believe it renders the squeeze thesis irrelevant to any rational investment decision. Paitea's acquisition of the secured debt is a checkmate. They've extended covenant waivers only until January 15, 2026. This short leash forces the board to agree to Paitea's terms, which means Chapter 11, or more likely, a rapid foreclosure process.
That January 15th deadline is crucial, though, because it provides a fixed window for a potential volatility event.
Yes, but how can any technical squeeze overcome Paitea's absolute control over the capital stack? We just discussed a credit bid. Paitea can acquire all the assets, the IP, the brand, the remaining contracts, through that $190.7 million credit bid. Any other potential bidder would have to bid substantially more in cash than that debt value, which the failed strategic review already proved isn't out there. The value is capped by the senior debt that Paitea now controls.
I acknowledge the near certainty of a credit bid resulting in zero recovery for equity. That is the eventual fate. That's the destination, if you will. But the timing and the path to that outcome, they matter significantly more to the highly capitalized volatility trader than they do to the fundamental analyst.
The end game is zero, so why trade the path?
Because the path is determined by human behavior and market microstructure, not just the balance sheet. Institutional long holders have already cleared out. We saw that massive 22 million share off-exchange volume on December 1st following the Paitea news. They capitulated. The remaining action is a battle between levered short sellers and high-frequency traders exploiting these liquidity gaps. The sheer size of the outstanding short position makes the risk of a technical default, the squeeze, asymmetrical to the downside for the shorts. That's the informed gambling aspect. It's betting on a technical flaw in the structure of the bearish trade, not on a recovery of the business itself.
But let's look at what Picea actually wants, because that informs their actions. The value Picea seeks is simply the room their brand name to attach to its generic ODM hardware. I mean, they were formerly 3 Robotics, and they're already making these perceived clones. This strategy, where the hardware is generic and runs Picea firmware, is actively eroding the brand's premium value and its competitive moat as we speak.
That's a valid point about the IP deteriorating.
So this lower residual IP value means Picea's credit bid will be even less forgiving to equity holders. The liquidation price is actively falling, which only reinforces the fundamental zero thesis. Why would Picea delay the inevitable if the asset they want is declining in value?
Well, the decline of perceived brand value simply lowers the expectation for any liquidation price, reinforcing the bear case. I agree. But it doesn't eliminate the technical trading risk that's driven by that crowded short position. And furthermore, we have to point to the company's governance paralysis, which virtually guarantees that the corporate action, when it happens, will be chaotic, providing the ideal setup for a squeeze.
Can you explain the governance deadlock for our listeners?
It's corporate self-sabotage, really. The company failed miserably in its proxy proposals during the 2025 annual meeting. Things like eliminating supermajority voting or declassifying the board. They required a 75% approval threshold, and they failed spectacularly. This means management is essentially handcuffed. They cannot execute necessary actions like securing shareholder approval for a reverse stock split, which they'll need if the price drops further just to maintain their NASDAQ listing.
They're in a reactive position only.
Exactly. This governance gridlock makes a chaotic forced event, whether it's an involuntary delisting or a forced bankruptcy filing prompted by Picea, the most likely near-term catalyst. And those chaotic events introduce immediate, unpredictable volatility, which is precisely what squeeze traders are looking for.
I think that governance deadlock simply reinforces the zero-value thesis by guaranteeing the path to the bottom is unmanaged. I mean, IRBT has never done a reverse stock split, but its current price, trading in the $40 to $60 range, it puts it dangerously close to the NASDAQ $1 minimum bid price rule. If they fall below that, they have a short window to regain compliance, usually by doing a reverse split. But the inability to pass governance proposals, especially that 75% supermajority threshold, makes any attempt at capital structure engineering virtually impossible.
They can't manage their way out of this listing issue. I agree.
So this guarantees one of 2 fatal outcomes for equity: either delisting to the OTC pink sheets, where liquidity vanishes and institutional interest just completely abandons it, or, more likely, an outright Chapter 11 filing prompted by Tricea's unwillingness to extend that waiver past January 15th. Both outcomes are fatal.
Right, but the governance deadlock simply increases the binary nature of the trade, which is what the volatility arbitrager craves. If the stock falls below $1, delisting accelerates the fundamental collapse. But for the short squeeze thesis, the focus remains laser sharp on the single specific event, the Tricea announcement triggering the final corporate restructuring. The short sellers are vulnerable to an unexpected announcement, not the protracted, slow failure of governance. The outcome is binary. Either Tricea triggers a momentary, violent squeeze, or the equity gradually bleeds out toward zero, whether that's on NASDAQ or the OTC.
I find that focus highly speculative. You're betting a momentary technical spike against the absolute certainty of a financial guillotine. The risk-reward here is severely skewed against any shareholder who holds through this.
And the volatility trader is fine with that. They're trading volatility, not value. The massive short interest is the anomaly that provides the chance for outsized technical gains, even if the probability of the event itself is low. It's a lotto ticket trade driven by the recognition that institutional shorts are highly levered and deeply vulnerable to unexpected news, no matter how brief the resulting price spike is. The question for the short seller is, do I want 12 million shares worth of risk riding on the predictability of Picea's announcement?
But my argument stands on the foundation that sophisticated acquirers during that strategic review did their due diligence and walked away because their bids offered zero recovery for common shareholders after debt. The market moved to price the equity as an out-of-the-money option the minute the Amazon deal failed. Picea has simply formalized that reality with its debt acquisition. The risk of the short seller is a function of the volatility, yes, but the risk of the long shareholder is a function of the capital structure, and the capital structure is lethal.
And the volume profile on December 1st showed the institutional capitulation. We are past the fundamental story, yes, but the story now is who covers first when PCA makes its final move. And that uncertainty is what creates the technical risk that is actively being traded.
Okay, so I think we've covered the primary tension inherent in iRobot Corporation today. The certainty of its financial fate, defined by structural insolvency and PICEA's control over, $352.2 million in debt and production versus the highly speculative technical trading scenario driven by extreme dark pool shorting and retail gambling on a momentary short squeeze.
It's a fascinating juxtaposition between fundamental reality and market mechanics. A classic modern example of how a deeply crowded bearish trade can introduce its own unique, unexpected technical risks and trading dynamics, regardless of the underlying corporate health.
My position remains. The fundamental reality, a sophisticated strategic creditor holding all the keys to foreclosure, means that the market's descent to all-time lows is fundamentally rational. It's viewing the equity as an out-of-the-money option with no material chance of an eventual payout.
And I would just emphasize the necessity of understanding the market microstructure. For an engaged investor or trader, understanding the technical vulnerability of short sellers, that 39.64% short float, the coiled spring, is as critical as understanding the Q3 2025 balance sheet, even if liquidation remains the primary eventual outcome.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.